This presentation is on markets of perfect competition. Perfect competition is a market structure in which the decisions of individual buyers and sellers have no effect on the market price. Perfectly competitive firm. This is a firm that is such a small part of the total industry that it cannot affect the price of the product or service that it sells. We consider people who are in perfect competition or perfectly competitive firms to be price takers. That's a competitive firm that must take the price of its product as given because the firm cannot influence its price. First, a few reasons why a competitor may be a price taker. If there are a large number of buyers and sellers, then any individual buyer may not have a very large influence on the market. If homogeneous products are perfect substitutes and indistinguishable across firms, meaning if there's not a big difference so you can't distinguish yourself. If both buyers and sellers have equal access to information, or there are no barriers to entry or exit. That is, any firm can enter the industry without any major issues. First question, if the perfectly competitive firm is a price taker, how does the price get set? Let's consider an example of a perfectly competitive firm. In this case, we'll say that all units sell for $5. You have to sell at that price, can't sell at a higher price. And they'll face a perfectly elastic demand curve at the going market price. Under the assumptions we made earlier, we can see that the price is set by the market equilibrium rate, but any individual firm just faces a constant demand, as they'll produce until the $5 they gain from any sale is outweighed by the cost it takes to produce an additional unit. That is, a perfect competitor accepts a price as given. If they raise the price, they sell nothing, and if they lower the price, then they'll have less revenues than they would otherwise, because they could always sell at $5. A perfect competitor has to decide how much to produce, and this is where profit maximization models come in. This model assumes that firms try to maximize their profits or minimize their losses. Total revenues, that's just the price per unit times the total quantity sold. Here are a few simple equations. Here, TFC is total fixed cost and TVC is total variable costs. In a perfectly competitive market, the average revenue is equal to the price. This is clear because at any quantity produced, you can always sell at that price. This table shows economic calculations for various levels of output. Here we've graphed those calculations, and as we can see, when the total cost curve is above the total revenue curve, we have losses here and here, and when the total revenue curve is above the total cost curve, we have a profit here and here. A firm maximizes profit or minimizes loss by producing at the quantity where marginal cost is equal to marginal revenue. In this case, it's here at E. And if we look back, we can see that indeed this quantity provides the largest profit. Profit maximizing rate of production. The rate of production that maximizes total profits or the difference between total revenues and total cost. Also the rate of production at which marginal revenue equals marginal cost, as we've recently discussed. Marginal revenue, the change in total revenues divided by the change in output. Since in a perfectly competitive economy, we don't change the price by increasing our output, our marginal revenue is equivalent to our average revenue, which is equal to the price. Marginal cost is the change in total cost divided by the change in output. Again, our profit is maximized or loss is minimized, where marginal revenue is equal to marginal cost. Now let's try to figure out how much the optical disc producer is making in total profits. Using information from previous slides, you can rewind if you need to, we can derive this graph. Here we can see that we are producing where marginal cost is equivalent to marginal revenue, in this case price, and we can see our average total cost curve here. at this quantity, our average total cost is here at roughly 4.5, and our average revenue is right here on the price curve. So for each one, we're earning $5, and it's costing us roughly $4.50. So we can calculate our profits by the difference here times the total quantity. Now let's look at the case where we're operating at an economic loss. Here, at our new demand curve, we have marginal revenue equal to marginal cost at this particular quantity. Again, we consider our marginal revenue, which is our average revenue, which is here at roughly 3, and our average total cost at this point is again roughly 4.5. So we're making this much, and it's costing us this much per unit. So the difference here times the total quantity we're producing is our total loss. So, who would continue to operate a loss? Does it make sense in the short run? How about in the long run? It turns out that in the short run, it's possible that we should continue operating even at a loss. So long as we're covering variable costs, the firm's going to be better off by producing now so that we can pay some of our fixed costs that we incur regardless of whether or not we make something. Let's consider two prices. The short-run break-even price. This is the price at which a firm's total revenue equals its total cost. In this case, the firm is just covering its explicit and implicit costs. The short-run shutdown price. This is the price that just covers average variable costs. That is, if the price is any lower than the short-run shutdown price, it would be more worthwhile for the firm to not produce anything. Here we can see on the graph the short-run break-even point and the short-run shutdown point. So why would we produce if we're not making a profit? The answer is simple if we just remember that economic profits and accounting profits aren't the same thing. Remember, economic profits can be zero while the firm has a positive accounting profit. The short-run supply curve of a firm in a competitive industry is just its marginal cost curve at and above the point of intersection with the average variable cost curve. The industry supply curve, the locus of points showing the minimum prices at which given quantities will be forthcoming, also called the market supply curve. It's just an aggregation of individual firm supply curves. Here we can see two separate firm supply curves. Well, they're marginal cost curves. And in panel C, we see the summation of those two curves. Here are several factors that influence the industry supply curve. Firm's productivity, factor costs, taxes and subsidies, and the number of sellers in the market. As we said before, the going price, or the market price, in a competitive market is just the equilibrium price set by the market demand and the market supply curves. Here we see the intersection of the market demand and market supply curves, and as we've already seen in earlier chapters, this is the equilibrium price. Taking this equilibrium price as given, any individual firm can make their calculations. Profits and losses can be seen as signals for whether or not resources should leave or enter an industry. Signals are just compact ways of conveying information to economic decision makers about what decisions would be best. An effective signal not only conveys information, but it also provides an incentive to react appropriately. If there are economic profits in an industry, firms can see this as a signal to enter that market. Conversely, economic losses are a signal that resources should probably not be going to that market. Allocation of capital and market signals. Price system allocates capital according to the relative expected rates of return on alternative investments. Investors and other suppliers of resources respond to market signals about their highest valued opportunities. We see a tendency towards equilibrium, although note that firms are always adjusting. At the break-even point, resources will not enter or exit the market. In competitive long-run equilibrium, firms will make zero economic profits. Earlier, we were considering the short term, where firms can't remove their capital from an industry or add new capital to that industry. However, long-run industry supply curves, just supply curves showing the relationship between prices and quantities after firms have been allowed time to exit or enter the industry. In a constant cost industry, the total output can be increased without an increase in the long-run per cost units. Its long-run supply curve is a horizontal line. In a constant cost industry here, we can see that when demand shifts out and our price per unit goes up, E2, the new supply curve that shifts in reaction moves out, and our new intersection point is at exactly the same price as P1. So our long-term supply curve, long-run supply curve, is a flat line. Increasing cost industry. In this type of industry, an increase in industry output is accompanied by an increase in long-run per unit costs. The long-run industry supply curve slopes upward. In the increasing cost supply curve, we see that when the demand shifts out, the supply curve shifts to the point where demand intersects the long-run supply curve. And we see here that despite shifting out, the supply curve and the demand curve intersect at a higher price than the original. Conversely, we have decreasing cost industries. This type of industry is the opposite, where increased output leads to reduction in long-run per unit costs. Of course, this long-run industry supply curve slopes downward. Similar to effects in the other two types of industries, when the demand curve shifts out, the new supply curve shifts until the new demand and the long-run supply curve intersect with the new supply curve. In this case, that intersection leads to a price that's lower than the original price. These types of changes can occur because in the long run, the firm can change its plant size and adjust until there's no incentive to change. That is, it maximizes its profits. In the long run, a competitive firm produces where price, marginal revenue, marginal cost, short run minimum average cost, and long run minimum average costs are all equal. In this graph, that would be this point here. Marginal cost pricing. In this system of pricing, the price charged is equal to the opportunity cost to society of producing one more unit of the good or service in question. The opportunity cost is the marginal cost to society. Market failure. This is a situation in which an unrestrained market operation leads to either too few or too many resources going to a specific economic activity.